Hello everyone, welcome to a new video. Today I will be analyzing the company of FWRG Restaurant Group, which if everything goes as planned, it should be going public this upcoming September 30th, 2021 in the NASDAQ under the ticker symbol FWRG. As always, my aim with this video will be to analyze the most relevant aspects of the SEC filing that they published, which is publicly available, and if you want to check it out, the link to it will be down below in the description. And afterwards, if based on this video you like the company, you think that potentially it could be a nice investment, then you can go ahead and you should go ahead and do your own due diligence on it. Nevertheless, before we go into the video, into the whole explanation and everything, let me just quickly highlight the main topics that I will be covering in today's video. Firstly, I will start with a general introduction to the company, and we will also look at some key metrics to understand its business better. Afterwards, we will quickly go into the industry and also the competitors, followed as always by the financials, and we will compare the financials of FWRG with those of two other competitors, which in this case I selected Denny's and Cracker Barrel, followed as always by the IPO price and the valuation, and we will also compare this valuation to the two competitors that I just mentioned now. And finally, as always, I will be giving my personal opinion on the company and my future plans with it. With that said though, and after I remind you that if you enjoyed the video, it would be super awesome if you could give it a like, because these videos really take a lot of time to make, and please also consider subscribing to the channel if you want to see more IPO related videos. But as I said, with that said, let's go for it. FWRG is an American chain of restaurants that was founded back in 1983 and currently has 423 restaurants. Out of these, 335 are company owned and 88 are just operated by franchisees. So they have two kind of different business models. On the one hand, they basically own and operate their restaurants, and on the other hand, they also have a network of franchisees. However, on the part of franchisees, actually since 2017 they don't accept any new partners to work with because they don't want to further promote that area of the business. They prefer to just own and operate the restaurants themselves, given the returns that they are giving. And actually, on the franchising model, they only work with multi-unit restaurant operators, and currently they have a total of 15 different ones. And between these 15 operators, as we said before, they are operating 88 different restaurants. The fees that the franchisees need to pay include a one-time payment of between $35,000 to $40,000 just for each new restaurant that is open, and then on top of that there's the royalty fee, which ranges between 4 to 4.5% out of the total sales, and then there's another fee, which is the one for public relations, marketing and advertising, that of course is benefiting the whole company, which usually ranges between 1 and 3% of the total sales. Going back to the restaurant chain, they operate a daytime dining concept, which means that they only really open during daytime hours, and that is from 7 in the morning till 2:30 p.m. in the afternoon. This means that they cover breakfast, brunch, and lunch. And on the one hand, you would think, oh, that's a bit maybe silly, or they are missing out on revenues that they could make if they would also offer the option to have dinner in their establishments. But on the other hand, from a human resources side, the employees are very happy, and they are apparently amongst the happiest within the hospitality industry, because of course the shifts are much better. You just have one full shift, you don't have split ones as it's very common in many other ones. And yes, of course you still need to work during public holidays and weekends, but that's something that comes with the hospitality industry and the F&B sector. And actually, something that reflects what I just said now, especially on the employee side, is that apparently they have a turnover only of 29% compared to the average of the industry, which is of 41%, and that's data from Black Box. Their restaurants are usually able to accommodate between 120 to 140 customers, and actually the new ones that they are building now are a bit larger in size to be able to have more customers and cope with all the demand that they are currently having, which is of course a good sign. And then mostly each establishment makes between $1.7 to $2 million per year, at least based annualizing what the different restaurants made during the first half of this 2021. And on locations, as you can see them up in the screen, they are distributed in several different states within the US, mostly in the East Coast, and it is only operating on a national level within the US, so no international locations. Also, if we look at their growth over the past years, we see that even with COVID, the system-wide restaurants have been consistently growing from back in 2014, in which they had 148, to so far this year at 423. In it, we also see that although initially the percentage of franchisees was very high, this is lower every year, and the trend should continue also moving forward. What is also interesting to know from an investment point of view is that during the 6 years prior to the pandemic COVID that of course disrupted the whole numbers, the organic sales of already existing restaurants, so restaurants that were already operating, grew at 6.3% on average annually, and the traffic growth to their restaurants at 1.4% as well annually, which also shows that not only they have been increasing the top line, and we will see later on, due to having new establishments, but also due to just simply organic growth. And on top of that, we also see that right now, which could be considered as, let's say, post-COVID area, the same restaurant sales growth for the Q2 of 2022 was of 16.3% versus the same quarter in 2019, so the pre-COVID scenario. On growth moving forward, the company plans to grow through, of course, having new establishments, but also efficiencies and increasing sales of the already existing ones. And actually, according to their S1 filing, they can get to have up to 2,200 different restaurants within the US. They did an analysis of where they could put them and so on, and that's more or less where they reached at, which is a 5x from the current count of restaurants that they have to date, which, as we said at the beginning, is of 423. And the near-term goal, though, is to open 130 new restaurants, company-owned restaurants, from 2022 to 2024. In all of these, we should also talk about the major owner of the company, which I find quite funny because it is precisely the same private equity firm that was the major shareholder of the IPO analysis that I did last week, which was Sovos Brands. So it's the same one, which is Advent International Corporation, and after the offering of First Watch, so this IPO that we're analyzing today, it will be the owner of approximately 81% of the company, which means that they will have essentially full control over what happens with it. And then also, just for some context, Advent International Corporation acquired First Watch back in 2017. Reached this point, it is time now to talk about the industry and competitors. In terms of industry, they compete within the F&B one, more concretely in the full-service restaurants, which they have plenty of competition, not just from chains, but also from independent operators. Maybe they have been benefited a bit by COVID because very loads of individual operators, so maybe just family-owned restaurants, had to close down probably because of everything that happened and just simply not being able to sustain the business. But still, they face major competition from lots of other chains. For instance, Darden Restaurants, Denny's Corporation, Cracker Barrel, IHOP, Waffle House, or Bob Evans, just to mention a few. But for today's video, I selected Denny's Corporation and also Cracker Barrel because both of them are publicly traded and they are of a relatively same size as First Watch, so they are more comparable to them. Firstly, Denny's, it is a full-service restaurant chain that currently has 1,645 restaurants, not just in the US but also internationally, and opposite to First Watch, it mostly does franchises and they only own 65 of the restaurants are basically company owned, so exactly the opposite. And also in most locations they open 24 hours, so 24/7, 24 hours a day, 7 days a week, and the company is very well known for its breakfast offering. Then moving on, the Cracker Barrel, it is a chain operating 664 restaurants which are company owned, so no franchises in this case. And its restaurants consist of a small shop with a restaurant next to it, and they are serving breakfast, lunch, and dinner. Although none of these concepts is exactly the same as that of First Watch, as I said, it is hard to find a restaurant chain that fits exactly the same because, of course, each one of them has its particularities. Now, before going into the comparison of the financials, let's look first at those of First Watch. And starting with revenues, we see that last year, due to the pandemic, revenues dropped 21%. But this year, 2021, revenues seem to be picking up strongly. The estimation you see is just multiplying the revenues of the first half of this 2021 by 2, assuming that at least they will do the same. And if this is the case, they will have 64% year-over-year growth and 29% if we compare the ones of 2021 to those of 2019 levels, so basically pre-pandemic levels. Of these revenues, as you can see in the income statement, only 1% come from the franchise and the rest are from its company-owned restaurant sales. And then going deeper into the last ones, you can see that this stayed strong thanks to the increase in delivery as well as takeout sales. On the bottom line, the company lost money both in 2019 and 2020. However, during the first 6 months of 2021, they reported profits, which if we extrapolate on a yearly basis, assuming that during the second half of this year they do the same, they would get to $3.5 million in profits. And also interesting is to look at the EBITDA margins, which in 2019 were of 8.7%. In 2020, due to the situation, they stood at minus 1.7%, and then during the first half of this year at 12.5%, also showing substantial progress on the bottom line. Afterwards, looking at the balance sheet, we see that they have a debt ratio of 68.76%, which is okay, and actually it will get better after the offering as they will be using the proceeds mostly to pay down debt. But how does First Watch compare to the two competitors that I selected? Well, we see that they all were very negatively affected by the effects of the pandemic. On Cracker Barrel, though, it's important to state that their fiscal year goes from August to July each year, so the dates compared are not the exact ones to the other two companies. This is why they have a bit of revenue growth this year, because it already takes into account the first 7 months of 2021, which have already been much better for all F&B establishments in general. Also, on revenues, it's worth noting that those of Denny's already dropped before the pandemic in 2019. Not sure if they sold some of the company-owned restaurants because the net income margins that year were much higher than usual. So to me, it seems like they did some of that. And also note that the revenues of Denny's look smaller despite having more restaurants, but that's because of the franchise model that they operate, as the revenues being reflected here correspond just to the royalties and other fees that the franchisees need to pay, but not to the system-wide sales generated by all its restaurants, because this would be much higher. On net income, though, we see that both competitors pre-pandemic were profitable. Now let's talk about the valuation, and firstly starting with that of First Watch, and with the information that I have available at the moment of preparing this video, it is expected to start trading between $17 and $20 per share, and taking the middle point of that, the amount of shares outstanding after the offering and the sales for the past year 2020, we have a price to sales ratio of 3.19 times sales. Nevertheless, if we do the forward price to sales ratio based on the expectations we set before when talking about revenues and net incomes for 2021, we have a forward price to sales ratio of 1.94 times and a forward PE ratio of 309 times. On a price to sales ratio, its valuation is cheap. But then looking at the PE ratio, it looks pretty expensive, but that's because they are just reaching profitability right now, and the net income margin of the profits that they will report this year is just of 0.62%, which is of course much lower than the competitors and what we saw earlier on. But that's also because they are focusing a lot, or basically reinvesting everything that they are making back into the business to try to grow more on the top line and expand more the chain. But I feel like in the next years to come, the bottom line will improve a lot more, and also the PE ratio then will decrease. Comparing it to the two competitors from earlier, we have that based on the 2020 revenues, Denny's is trading even a bit more expensive and Cracker Barrel significantly cheaper. So actually, I don't see First Watch trading very expensive if it really goes public at the mentioned price. Especially because I would expect First Watch to grow significantly more than any of the two competitors that we saw earlier on. And actually, just from the organic sales, we know from earlier on that during the past 6 years before COVID, they were growing roughly at 6.3% organically. So just from the already existing restaurants. If we extrapolate this for the next 5 years to come, we could say that already just from organic growth, they will grow at this rate. But then we should add on top of that all the new openings of new restaurants that they will make, which we also know that they said that they want to open 130 new restaurants between 2022 to 2024. This means that during these 3 years, they will open on average 43 restaurants per year. And if we divide this over the current restaurants that they have, which are 423 approximately, This means a 10% year-over-year increase in restaurant counts, which should also reflect more or less in 10% year-over-year increase in the revenues. So we have that, I would say, at least during the next 3 to 4 years, I would expect them to grow year-over-year at around 16%, which includes the 10% growth from new establishments being opened, plus the 6% from organic growth of the already existing ones. With all of these, what will I personally do? Well, I don't have any plans to invest directly on IPO day, and most probably I will just monitor the stock during the next months or quarters to come, see how are the results that they publish, especially focusing on how much top line growth there is and also the bottom line, whether the net income margins improve. But probably if the stock falls below $15 per share, I might really consider and buy shares, because I feel like at that price point there is enough margin of safety, and I already feel like the current valuation it's not that overvalued. And also, if during the next years to come they are able to reach the net income margins of the two competitors that we saw earlier, which range between 6 to 7%, then I think that the current valuation is certainly reasonable, and if it falls to $15 per share, there's for sure upside potential. Anyways, that's it for today. Please remember that everything I share in this video is just based on my research, my calculations, and my opinion, which all of them could be wrong, so you should always do your own due diligence before investing in this or any stock, and I'm of course no financial advisor. With that said though, what are your thoughts on First Watch? Will you be investing in its IPO? Please let me know in the comments below. If you enjoyed the video, then don't forget to give it a like, subscribe to the channel if you are not yet subscribed, and as always, see you next time.